This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft. Thank you all so much for the continued support and for tuning in. If you like what you hear at the Planet MicroCap Podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. This really helps more folks discover the show and join the microcap investing community. Registration is open for the Planet MicroCap Showcase Toronto in partnership with MicroCap Club, taking place October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll definitely want to be there. Visit planetmicrocapshowcase.com to register, and I'll see you in Toronto. My guest on the show today is Asif Suria. He's the founder of Inside Arbitrage and co-host of the Special Situations Report podcast. In this episode, Asif shares his evolution from traditional value investing to a diversified event-driven strategy that includes merger arbitrage, spinoffs, buybacks, insider activity, and more. We dive into his, and I quote here, his three-legged stool process, combining event triggers, a 14-factor quant model, and deep qualitative research, and how it's helped him navigate both opportunities and challenges in special situations. Asif also walks us through real-world examples, highlighting lessons learned from his biggest wins and most humbling setbacks. Asif mentions a number of companies during today's episode, and I'm not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap Podcast, and please enjoy my conversation with Asif Suria. Asif, thank you for joining me today. How are you doing?
I'm doing great, Bobby. Thanks for having me on.
Absolutely. It's great to have you. So listen, what inspired me to reach out is, I heard your interview that you did with Andrew Walker on Yet Another Value Pod. I think it was, must have been over a year ago now, something like that. And, you're doing great work on the, inside arbitrage side, M&A activity. There's some special situations. There's so much we can get into, especially with regard to microcaps. I know you're not just specifically a microcap person, but, kind of covering everything having to do with this theme of investing. So wanted to have you on to kind of get a better picture from a macro perspective. And maybe there's some micro stuff we might be able to get into. So with that, Asif, my first question I love to ask everybody on here, where did your passion for investing begin, and how did that passion and original, interest then evolve to what you're currently doing today?
Yeah, so for my passion for investing started somewhere around 2001. This is probably the worst time to get into investing. The dot-com bubble had burst. Stuff was trending down. I thought, there was great value out there, but it continued going down for another 2 years after I started. I was in Omaha earlier this year, and Warren Buffett was talking about US capitalism being a cathedral, and then you have a casino attached to it. And my initial opinion of investing back in the late 1990s was it was all casino. And so my passion developed over time. I started reading, books of Ben Graham. I read Phil Fisher, Peter Lynch, all of that. So started out as a value investor. And then I quickly ran into not just the dot-com bear market, but also the 2008, 2009 Great Recession bear market, which was really deep. You had the indexes decline as much as 50% or more. And that got me thinking about maybe there's a less painful way of approaching investing. Maybe there's a different way of looking at things. And that's where I started getting into event-driven investing. The first event-driven strategy that I got interested in was merger arbitrage, which, as you know, is a company acquiring a different company, and the target company that they're acquiring is trading at a small discount, if you will. Or in some cases, like Nippon Steel buying US Steel, a very large discount because everybody expected that deal to get killed by the regulators. Having a programming background and a software engineering background, I ended up building a tool called the merger arbitrage tool that could track spreads, or basically the difference between the acquisition price and the current market price. And at any given point in time, there were 80 to 100 new deals that were there in the market that were active. And so I started tracking that on a website that eventually became Inside Arbitrage. So I started with insider transactions, which isn't traditionally considered a special situations or event-driven strategy, and a merge arbitrage, and then eventually expanded to spin-offs, buybacks, SPACs, and more importantly, management changes.
Very good. So, I mean, what was it about, the event-driven side of investing that, you were finally like, all right, I went through all this painful 2001, painful 2008, 2009. What about event-driven for you was like, all right, I think this could be a less painful way to invest?
Yes, as you and your listeners are aware, markets, especially in the US and certain other developed markets, are actually quite efficient, except in pockets. So there are pockets of inefficiencies, whether it's GameStop, the meme stock mania, if you have.
Microcaps,
Exactly. Yeah. So you guys focus on microcaps, which is an area of inefficiency because that just isn't a lot of institutional money that can play in that arena. So you still have an opportunity there. But when you look at the broader market, unless you are fishing in Kenya or maybe some frontier markets, you're going to see a lot of efficiency. And what I realized was event-driven strategies potentially give you an opportunity to participate in a less efficient market, if you will. So if a company is spinning off another company, all of a sudden you have to fully understand what's happening here. Do you want to invest in the spin-off or do you want to invest in the parent company? And what do both of these businesses look like going forward? So there's no history as such, post-spin-off, if you will. And so that creates a certain amount of inefficiency. There's also natural inefficiency built in where if you own a company, for example, Jefferies, the investment bank, and they're spinning off a division like Vitesse Energy, which is an energy company, you probably don't want the energy company and you're going to sell it off or forget all about it in your portfolio. And that creates a certain amount of selling pressure that Greenblatt discussed in his book, You Can Be a Stock Market Genius. So you have a combination of this thing where the spin-off is likely less understood than the parent, and you have the extra selling pressure that creates an opportunity. So I find that to be fascinating where event-driven stuff surfaces inefficiencies that could potentially lead to outperformance over long periods of times.
Absolutely. So a quick housekeeping. So when you were, obviously you started Inside Arbitrage and now co-host of the Special Situations Report podcast. I mean, do you manage your own money? Do you run a fund? What's the vehicles in which you're deploying your strategies?
Yeah, so I've been managing my own money for a long time. I also started managing money as a registered advisor in California for a few friends and family. So that started a couple of years ago. I'm growing it really slowly. Primary focus is our research platform, the Inside Arbitrage.
Very good. All right. So, I mean, love to understand from your perspective when you started really developing the event-driven strategy, what your ideal investment looks like. I'm sure it changes depending on what the actual event is, of course, which we'll get into a few examples, I'm sure, in a little bit. But for you, what does that ideal investment look like?
Yeah, so if you have
setup.
Yeah.
Okay, go.
So when you think about tools and tool sets, and if you have a hammer, everything probably looks like a nail to you, right? Because that's what the hammer is best set up to do. It can obviously destroy drywall and do many other things. But the way I thought about event-driven strategies was certain strategies come in favor and then go out of favor. So I wanted to have a toolbox with multiple strategies that I could deploy at different points in times. So, for example, the last couple of years were actually very difficult for merger arbitrage because of the regulatory environment in the US. If Lina Khan heard that there was a deal announced, they would try to figure out how to kill that deal or delay the closing for as long as possible. Don't get me wrong, I think antitrust has a place in the world to protect consumers. So if you only had two large airlines, like let's say United and Delta, and they decided to merge, consumers would be left disadvantaged because they would not be able to find good prices and the airlines could charge whatever they wanted. But for the regulators to kill a deal like Spirit Airlines acquisition by JetBlue and yet allow Alaska to continue to buy Hawaii, and the whole regulatory landscape didn't make a lot of sense. And so you had this situation where you couldn't make rational choices, whether it was Tapestry buying Capri. I mean, why wouldn't somebody want to pay a little bit extra for a luxury handbag? The whole concept of luxury handbag is you want to buy it for more as a status symbol or whatever else pleasure people get from overpaying for these things. But why would you want to go kill a deal like that? So what happened over the last 2 years And I see you smiling, Bobby. So maybe
I was always smiling because I feel like I should hit up Andrew right now. Like, yo, and go. Do you want to jump in right now? Yeah, he would definitely have a lot to say about this for sure.
Exactly. So what happened was we had this period of 2 years of very irrational antitrust, if you will. And so it became very hard for us to assign probabilities to deals closing. And so this was a situation where merger arbitrage had worked for me for 13 years before that. And then the last 2 years were very difficult. But if you go back a couple of years before that, spin-offs were actually quite difficult at that point in time. You had a bunch of spin-offs that weren't working. And now spin-offs seem to be a great area that continue to work at this point in time. So the idea behind adopting these 6 different strategies was to generate ideas. And we generate about 100 ideas, maybe a little too much on Inside Arbitrage each year. But tracking these transactions allows us to go ahead and do that and generate ideas from different areas if one segment of these strategies is not working.
So awesome. So, continuing on this, thought process where, you wanted to create a strategy that was very all encompassing so that you weren't just really heavily weighted in merger arbitrage. You had, how did you think about, I guess, what was some of your criteria for all the different event driven things that can happen so that, you had more of a balanced strategy?
Yeah, and so the idea was to have something that was truly an event. It had to be a spin-off, it had to be an M&A transaction, it had to be a management change. That's a pretty big area that for some reason retail investors and often professionals don't pay a lot of attention to. And I understand that because it's so hard to evaluate the quality of management upfront, and often even when they're operating the companies. You can see it in the numbers, but it's still very hard to figure things out. So management changes, SPACs, which can provide a whole host of ideas, both on the long side as well as the short side. Buybacks, a company is basically making a statement when they announce a large buyback. They're saying, we think the stock is underpriced, and it presents a great value compared to what the market is viewing it as. And then the last thing is insider transactions, which aren't considered an event, but we love to see insider transactions overlaid against other events. So if the company is buying back its own stock and the insiders buying stock at the same time, we call that our double dipper screen. So we like to overlay insider transactions against other strategies. Is a company that was spun out seeing insider transactions, or is the parent company that spun off or division starting to see insider transactions? So while not traditionally considered event-driven, we like to track insider transactions. So everything we could think of that's an event we would like to track. There are a couple of things we don't track. For example, bankruptcies. Bankruptcies require a lot of legal expertise and are very difficult to analyze for retail investors and sometimes even professional investors who are not focused on that niche of the market. So that's an event-driven strategy we haven't adopted just because of the complexity and the need for legal talent to be able to analyze that.
Absolutely. So I'd love to dig into your process here because I think, I also read, So You Think Your Stock Market Genius, and he obviously goes through everything that you just said and why, making the compelling case as you're doing right now about like why you should be looking here. But what always, my main question that came up with each chapter as I was reading about spinoffs and this was like, okay, well, what's the ideal process to then participate or not? Because you don't want to paint with a broad brush of like every management change. Oh, there could be unlocking alpha here. It also could be a bad thing. You could have a great management team that's now retiring and now they're bringing in their protege. That's, a bit of a dingleberry, you never know. So for you, what's your process then for once you see the event happens and then what's the next steps from there?
So we have 3-legged stool, if you will. The first is the event. So that's the idea generation thing that starts the process. We also built a model. It's a 14-factor model, quantitative model. Considering my background in engineering, I'm fascinated with models. So we ended up building a 14-factor model that basically classifies every company in the US. So we classify everything and give it a score. And so anything that meets a score of 70 or above, we are interested in taking a closer look. And then the qualitative work starts. There might be situations where the qualitative work might point to something interesting, even though the quantitative score might not be quite as high as we would like. So it's the 3 steps of the stool, the event for the idea, quantitative, and then qualitative. On the qualitative side, I can give you a couple of examples because it's interesting to talk about all this in theory, but then sometimes you have to really dig in and look at it.
100%.
And I'm going to commit blasphemy here by going and talking about mega cap companies instead of microcap, but it just proves to be a good example. So we talked about how it's important to track management changes, and this can be very interesting if you're looking at something like sudden departures. So if you have a biotech company and the chief medical officer, the chief scientific officer decides to suddenly depart with less than 30-day notice, that could be a great red flag for you to keep an eye out on. Could be the same with the CFO, the chief accounting officer, suddenly deciding to depart with very little notice or transition time. But on the other side, appointments are also very interesting. So you could have companies that have not done well for a long period of time, and they bring in a CEO who can transform the company. The thing that I like to say is turnarounds rarely turn around, but when they do, it could lead to some tremendously positive outcomes. So for example, on the qualitative side, we noticed two large companies that had new CEOs. On the one hand, there was Larry Culp at GE, who had come over from Danaher. And then you had Pat Gelsinger at Intel. Intel has a new CEO now, but previously they had Pat Gelsinger. He was an engineer. He had invented a bunch of things at Intel and was brought back in after he was the CEO of VMware to turn things around at Intel. Trying to turn around these massive mega cap companies is like trying to turn the Titanic around, and it can take several years. For the most part, ends up being unsuccessful. So on the qualitative side of things, we looked at the background of both these CEOs. Larry Culp came over from Danaher, and as you probably know, Danaher has this system, an internal system called the Danaher Business System that you can think of as part Kaizen, like the Japanese system of managing companies, and part Six Sigma, which probably traces its roots all the way back to the late 1990s. So you had Six Sigma and Kaizen, they built the Danaher Business System. And so Larry Culp, at his time at Danaher, he basically ended up over 14 years quadrupling their revenue and quadrupling the stock price, if you will. So you saw this amazing performance, and he comes into GE, which was a completely broken company. You had a CEO that had two different planes. One a private jet would follow the other one in case the first private jet had a problem. So there was a lot of waste in the company. It was a company that was heavily diversified in all kinds of business units. It was heavily leveraged. The balance sheet had a lot of debt. So we started seeing Larry Culp execute a playbook of starting to do a bunch of spin-offs. So the spin-offs basically helped him get rid of divisions that they didn't want to focus on. And they, as is usually the case, they loaded up the spin-off with a bunch of debt. So by the time he ended up going through this process, you ended up seeing GE, the parent company, essentially becoming a lean aircraft engines company with high margins and high revenue growth, and essentially a pristine balance sheet with no net debt. Along the way, I happened to see him buy stock as an insider transaction, and that's what really got me interested. So you had this management change, and then you had an insider transaction. After he bought the stock, it actually went on to decline quite a bit, and that provided a nice opportunity for us to get in. Over the last year, I think GE is up 58%, and over the last 5 years, it's up 700%. But when he was first appointed, you saw that the stock went up a little bit, but then went on to decline 40% because these things take a lot of time to turn around, and you're probably going to have a string of quarters or years where negative results are going to continue to come out. So the nice thing with a company in the microcap space is you could probably start to see these changes happen in the span of a few quarters instead of a few years. And so paying a close attention to the CEO and trying to understand what's going on, what the pedigree of the CEO is, where have they worked before, and then looking at how they're being paid. So we were negative on Intel because Pat Gelsinger's pay package was very generous, if you will. I think it was several thousand times what average employee at Intel made. So we looked at that and we saw how he was doing. He tried the same playbook. He tried to spin out Mobileye, but we weren't seeing quite the same results, if you will. So we decided to participate in GE. I still own the position for several years at this point in time, but decided to pass on Intel.
Absolutely. I mean, just looking kind of a larger eye view on this, 30,000 foot look, just already in 2025. I mean, I'm assuming you're running screens pretty often just to see, what pops up, what looks interesting, whatnot. Which events would you say have been happening more often that have been coming across the radar in the first, we're in August, we're recording this August 13th, so I guess it's been 8 months already. Jeez Louise. What would you say has been the most common area or hunting ground for the last, 6 to 8 months?
M&A. So M&A activity has picked up quite a bit because regulatory pressure has gone in the other direction. Things are being approved at this point in time. There are still a few deals that are being held up for certain reasons. There is a medical device coatings company that is being held up, Surmodics, because the company that's acquiring them is a VC firm that has one of its portfolio companies that also does medical coatings. So normally you won't see a company like that where a PE firm or a VC firm is acquiring them get blocked. But in this case, because a VC firm had this portfolio company, that is an issue. So it's not all clear, but it's clear for the most part, right? So 95% of the deals are likely to go through, which tracks well with our traditional metrics that we've looked at over 15 years. 94 to 95% of all deals actually end up closing. So we're seeing a lot of activity on the M&A front. I think things are heating up on the broadcasting side. So the TV stations that were not allowed to merge previously are getting excited that they might have an opportunity to do that. And we're also starting to see situations where there are bidding wars for companies. So for example, Dallas News, they had a deal where they were going to be acquired by Hearst. It was a $75 million deal. It was priced at $14 a share. And this deal should have closed in a matter of days. Some of these deals close in like 80 to 90 days. But along comes, I believe it is the company that manages M&G, which is a Colorado-based newspaper publisher that has the Denver Post, the Mercury News, and the Boston Herald. So they came up with a higher offer of $16.50, which is music to the ears of people who do merger arbitrage. Because you're usually just looking for a few pennies, you want to grab a few percent, and all of a sudden somebody comes along with a much bigger offer. So instead of engaging with M&G, what Dallas News decided to do was they struck a slightly bigger deal with Hearst. They said, we're going to go with a $15 per share deal. And they adopted a poison pill provision to limit M&G from adding more stock, if you will. So M&G already owns a 9.9% stake, and they adopted a poison pill provision that would dilute M&G's stake if they try to buy more on the open market. So M&G just this week came back with an even higher offer of $17.50. And Dallas News is right now trading at just a little over $15. So this is a strange situation where you have an offer for $17.50, and the company says we want to still get acquired by Hearst for $15, which makes absolutely no sense as far as shareholders are concerned. The fact of the matter also is Dallas News was trading at a little over $4 a share, so it's been a good outcome for recent investors, even though the stock has been down so much over the last few years that pretty much everybody else is likely underwater.
Absolutely. When you're thinking about your own portfolio, sorry, not to jump around, but I'm just, as it comes up, like when you're thinking about your own portfolio and you're like, okay, how much do I want to wait for, M&A versus, insider transactions, management change, because I would imagine, especially on the M&A side, you're dealing with, maybe, 20, 30% upswings, and it's more shorter term, like, okay, we got it at the low. All right, we wait for the transaction to close. Usually that takes a while, but once it closes, okay, we made our money there. But you see an insider transaction, like, okay, well, maybe there's something here where it's more of a longer term play because maybe they had a crap quarter and management's buying. That's kind of interesting. So how do you think about it when it comes to portfolio construction along with each aspect of the strategy?
I'm so glad you asked that, because portfolio construction over a period of time becomes all the more important than just generating ideas and doing your analyst work, if you will. So in terms of portfolio construction, I prefer to hold things unless it's a liquidation situation for at least 3 years, because it gives you some time for either the company to turn around or continue to execute. Sometimes it's much longer than that. So I have Netflix and Meta in my portfolio. I've held them longer, and I'll probably continue holding them for a long period of time unless I see things deteriorate on the business side of things. But when it comes to merger arbitrage, for me, the strategy was an alternative to fixed income investing. It might not be the same for everyone, But back when interest rates were zero, you got basically no interest when whether you had money parked in a bank or whether you had bonds. The rate of return was very low. So even if you had a deal that was generating, let's say, 3% returns, which is quite tiny, but if you have these deals that close every 3 months, that's a 12% annualized return, not taking compounding into account. And so that was very attractive for me compared to fixed income. So if you were to think of portfolio construction, if you go to a registered advisor and they say, okay, what's worked for me for 40 years is 60% in stocks, 40% in bonds. When stocks decline, I'm going to use the bond portion of my portfolio to buy more stocks. I even it out. It worked great while interest rates kept declining. And then you had the situation in 2022 where interest rates suddenly started going up and the bond side of the portfolio got killed. So in a situation like that, or a situation where interest rates are really low, merger arbitrage proved to be a wonderful strategy for me. And so when I think of the portfolio, it's more like, 60 to 70% stocks, 30% on the merger arbitrage side. But over the last 2 years, as I mentioned, things were so difficult, I probably had less allocated to merger arbitrage than I would have traditionally before that.
Absolutely. I'd love to hear another story from, let's say it was an idea that came up that maybe it was right around that 70 number, on the idea journey. Maybe it was 69, it was 68. You're like, okay, it's right there, but maybe we will take a deeper dive in it. You ended up uncovering something. You're like, okay, this is actually really interesting. Do you have any examples of stories like that through your career where that's happened?
So Bobby, I just want to clarify what you mean by the 6970.
Your factor model where you said like if it's 70 or above, sorry, I should have said.
Yeah.
When you're looking at your factor model, if it's 70 or above, that's when you take a closer look. So I was curious if you saw anything that was, 69, 68, maybe even 61, and you're like, all right, that's just below, and yeah, we want to be disciplined, but this one looks kind of interesting.
Yeah, so there are really no fixed rules. I have rules, but then they all have exceptions and they all are completely open to being broken, and I break them all the time. So the 70 model, the factor model, is actually helpful to quickly run through ideas, right? So for example, last night when we were looking at insider transactions, we probably looked at 40 of them. So every night we're looking at so many different transactions. In any given day in our daily event-driven monitor, you're probably going to find 30 to 40, 50 updates. And so how do we sift through all of this and how do we get to what's truly important? That's why the factor models help. But as we're looking at it, and we will even look at things that are rated lower, maybe even in the 30s and 40s. And as we look at it, and if something jumps out to us, because we're like, I remember this company was spun out a year or two ago. I wonder what's going on with it now. I remember seeing a management transition 3 months ago. So once we start seeing certain patterns or multiple different events are coming together, we will take a closer look. The factor model is to help us get through so many ideas quickly. There was a company called Biohaven that I've discussed on other podcasts that presented a completely fascinating situation. And this was before we built the factor model, if you will. So this was a situation where 3 different event-driven strategies came together. So you had this company, Biohaven, that was being acquired by Pfizer. And they were paying, if I remember correctly, $148.50 per share for the company. It was trading at about $140 when I started taking a look at it. And I was like, I could make about $7 or $8 on the merger arbitrage spread if the deal closes. And that was exciting enough for me. But things got even more interesting because there was going to be a spin-off that happened right before the deal closed. And the reason the spin-off was going to happen was Pfizer was interested in the migraines drugs that Biohaven had. That was what they wanted to buy. They were not interested in the rest of the pipeline that Biohaven had. So what they said was, okay, we're going to spin off the rest of the pipeline. You guys can go figure out what you want to do with those drugs. And we'll even give you, I think, $350 million or $400 million of cash to go figure out what you want to do with that pipeline. And so I looked at that and I figured just the cash value that they were going to fund this new company with was going to be worth about another $7 a share. So I get $7 or $8 on the merger arb, and again, another $7 on the spin-off side. And who knows what happens to the new Biohaven, the new pipeline, if you will. And right before the deal closed, there was only about 50 cents left. It was $148. The deal price was $148.50. There was an insider that actually bought stock. And we never see this. You don't see insiders participating to pick up 50 cents before the deal closes. So clearly the insider was more interested in the spin-off that was going to happen and not the 50 cents. And he wasn't participating in merger arbitrage like Warren Buffett or some of us do. And so we looked at that some more and we realized that the board member who bought stock had been on the board for quite some time. He used to be an emergency room surgeon, and now he was participating in Biohaven as a board member. And sure enough, it got spun out. The stock, the new Biohaven, went from $7 to all the way to $40, and the insiders kept buying all the way along. I didn't hold on for the whole ride. I got out with my $7 or $8 that I was looking for. But even without staying for the whole ride, it worked out to be a great situation where 3 different strategies came together. So that's the stuff that really excites us when we start seeing different things come together to create a unique signal that you won't normally see otherwise.
That was a great story. So, hey, Asif, so now I'm going to ask you for, a counterexample of where, all right, everything looked like it lined up according to what you were looking for, what you normally see as like, okay, this is a no-brainer, boom, it's perfect setup, this, that, the other thing, it all happened. But then it didn't work out for whatever reason. What does a not working out situation, I guess you'd say, look like?
Oh, I have so many examples of that, Bobby.
I know you got a hard stop. We could go. You say as many as you want. I think that's where most people love. Like, here we go. Here's the good stuff. So bring it on.
Yeah. So on merger arbitrage, it was Capri and Tapestry. There was no rational reason for that to fail, if you will. Spirit Airlines and JetBlue, you could still make a case for that. There was potential reasons why that would fail. And when we looked at both of those deals, we track a group of hedge funds that focus on merger arbitrage and do so in a concentrated way. So more than 50% of their portfolio is in the top 10 positions. And we report on them every quarter. When we looked at Spirit Airlines and JetBlue, the concentrated merger arb funds were not in that deal for the most part. They had avoided that deal. And these are funds that have billions of dollars, and they probably have legal stuff on their staff that can actually go look at these deals and try to understand the regulatory risk that might be out there. But when you looked at Capri and Tapestry, even Bill Gross was in it, and all of these merger arb funds were in it. And so we looked at that and we said, this seems like it would close. I probably took an outsized position more than I should have. And so that quite did not work out for us. That was one example on the merger arb side. On the spin-off side with insider buying, Lionsgate, Lionsgate Studios got spun out of Lionsgate Entertainment. That hasn't quite worked out for us for some time now. This was a situation where Lionsgate had acquired Starz for $4 billion, just as everybody was cutting the cord and wasn't watching cable TV anymore. So they overpaid for that acquisition. They've had an activist on their board for quite some time, Mark Rachesky, who used to be a protege of Carl Icahn. So we were hoping that, Mark Rachesky is going to, shake things up at the board level and make something happen. But the spin-off took a really long time to happen. It just happened not too long ago. And the whole situation is yet to play out. You now have a second activist involved in the form of Steven Mnuchin, who was a U.S. Treasury Secretary. And so now I'm hoping somebody else comes along and shakes things up there. But this is a situation that's been, spinning out there for so long and hasn't quite worked out for us yet.
Okay. What would you say of all of these experiences, whether on good, bad, indifferent, would you say was one that you really learned the most from and said, okay, this was an experience I'll never forget?
There was a company called Pinstripes. They are in the entertainment space where you basically go and do indoor bowling and then you can get something to eat. They do a lot of corporate events. One of their most productive, highest revenue generating locations is very close to where I live. And so I went and checked out the location. I asked a bunch of friends who had corporate events there. It looked like an amazing company that was growing. It met a lot of our criteria. For example, it was founder-led. I like to see companies that are founder-led. It was a micro-cap, so somewhere in your area, if you will. And it was growing, I think they had 13 locations at that point, and they were planning to grow to a significantly larger number of locations. They did decide to go public through a SPAC, which should have been my first red flag, because I've shorted companies that have gone public through the SPAC route. WeWork, for example, which worked out well. But in this situation, what I should have paid more attention to was the fact that Oaktree had a significant amount of debt that they had provided to the company. And so if the company couldn't execute, they couldn't grow the way they were going to grow, Oaktree would essentially end up owning the company through the bankruptcy process. And that was a big risk that I didn't pay enough attention to. And that's certainly stayed with me. I had a position for myself and for clients, and that's something that didn't work out. And it taught me to look at more things on the credit side of things and to be even more aware of companies that go public through a SPAC route, because the probabilities are stacked against you in those situations.
Absolutely. So to take this more to being microcap specific, we've you talked about a few microcaps and that you've come across and through your experience, but from an event-driven side, specifically with microcaps, is there anything special or even more that you heavily weight or have additional factors in when you're looking like, okay, these are microcaps that are kind of crossing the, coming across the ticker here that, meet some of our criteria, maybe are 70 or above, according to the 14 factor model, but you're like, okay, these are microcaps. So, is there anything special or things that you look at that maybe some of our audience members are like, okay, I should know about this if I'm going to look to deploy an event-driven strategy in microcaps?
Yeah, so one of the things with insider transactions is a lot of people think if the insider is buying, things are going to go well. They really know what's happening at the company. The market is probably wrong. More likely than not, the market is right, the insider is wrong. Strangely enough, I don't think people comprehend that quite as well. And that probably is because the market and the analysts are looking at the macro picture. They're looking at things across companies. They're looking at what's happening at the sector level, what's happening at the country level, which the insider who, is quite attached to the company, they are day in and day out focused on the operations of the company, might not quite perceive as well as the analysts might. So that's one issue that you have to be aware of. And the second thing is, just like us, they are human beings and they are prone to bias. And so the stock was $13 a share, and all of a sudden they see it at $4 a share. They might be anchored to an old price of $13 a share, and it might look cheap to them, even though it really isn't. So you see some bias that happens there. And the third thing is, Bobby, you and I might look at insider transactions, and they know that you and I are looking at it. So sometimes they just buy to signal to you and me saying, hey, maybe you should look at the stock. I'm buying a bunch of stock. And
or nothing's wrong here. Nothing to see. Look, I'm buying.
Exactly.
Company's
right.
Great.
Yeah. So all of that plays into it. And so what we look for often is not cluster buying just within a company, but cluster buying across a sector. So for example, in 2020, around May, I think is when crude oil went negative. WTI went negative, not Brent crude. And you could see the insiders come out of the woodwork across energy companies. It wasn't just one company, and you could just see them buy hand over fist, which was a tremendous time. I got into Continental Resources. I got into Diamondback Energy. That worked out great. 2 years after that, the regional banking crisis, if you will, when Silicon Valley Bank failed, you could see the insiders come out of the woodwork for regional banks and start to buy hand over fist. So when we see that with insiders across multitude of companies within an industry or a segment that's been hurt a lot, that starts to excite us. So you start seeing M&A activity where people are picking things up at the bottom of the cycle, and you start seeing insiders buying. So that combination, I think, is something we pay close attention to. And then the factor models go out the window and we start taking a look at the entire sector, if you will.
I've been publishing this podcast since 2015. That's the first time anyone has brought up that nuance. And that's very, very, very interesting. Where it's not just looking at on the individual side, but looking across the sector and seeing insiders buying. That's very interesting. I'm gonna pay attention more to that too. I'd never really thought of that. That's a really good point. So, look, I know you got a hard stop, but I thought, to close this out here, because you're going to come back on at some point, because I think it would be really fun to do kind of a quarterly or maybe biannual update of what's going on, what's been the trendiest thing going on in event-driven stuff. So maybe to close this out, you kind of covered what's been the most active in the most previous 6 to 8 months. What do you expect to see, if you had to have a crystal ball? What do you expect to see, maybe being very active as we close out 2026?
Yeah, so there's one sector that's been in a nuclear winter, if you will, for quite some time, biotechs. and especially zombie biotech companies, right? So these are the companies that have a lot of cash on the balance sheet. So there's net cash on the balance sheet. A primary product in the pipeline might have failed phase 2 or 3 trials, and essentially they don't have a viable business, if you will, if the management realizes that, but they have a cash-rich balance sheet because they raised a bunch of money. So Andrew Walker, for example, and a bunch of other folks we speak to, Christy Mood Jr., we had him on as a guest on our podcast. All of them are very interested in zombie biotechs. So they've been participating in it and trying to push management teams to do the right thing and return the capital to the shareholders. And if they feel like there's value left in other products in the pipeline, spin that off or create a CVR or structure or so on and so forth. What we're starting to see is two different companies that are starting to participate by buying these cash-rich biotechs. So you have Concentra Biosciences, Kevin Tang is involved, and they first started out buying companies that were less than $100 million with cash on the balance sheet, and they were announcing one deal a month. Right now, it feels like they're announcing one deal a week at this point, and they moved up to the $200+ million level. And then you have another company, and I believe it's called Zoma Royalty. They came in with 2 deals on the same day last week. So they're out there fishing at the bottom levels of the biotech thing. So if you start seeing this level of bottom fishing going on one end, and then pharma companies, restart their acquisition after their binge that they had with Pfizer acquiring endless companies with COVID cash, and so on and so forth. If you start seeing pharma companies start buying on the top end of the things, and insiders participating, then you might start seeing the cycle turn on the biotech side of things. The monkey wrench in the whole thing is the Trump administration really pushing down on prices for pharma companies, right? So that might be a key risk to be aware of, but that's an area, the biotech sector, which is something so far out of my core competency that I would never be interested in, but I'm starting to invest more in that with the help of some folks who work in research that can actually look at the pipeline and tell me if the pipeline has potential or not.
Absolutely. Oh, that's fascinating. Listen, you hit the nail on the head. It's been an absolute nuclear winter in biotech, especially in microcap, to say the least.
Indeed.
Oh my goodness. Well, all right. This was a great place to end it. Quick housekeeping. You mentioned a number of names here today. I'm trying to remember all of them. I couldn't even keep up. But I mean, were there any in particular that you or which ones do you own just for our own compliance?
I still own GE, the patent company. I own Meta. I own Netflix. Those are the 3 companies that I mentioned that I have a position in, and for clients.
Very cool. All right. Well, with that, Asif, where can our audience go and find more information about you as well as Inside Arbitrage?
So you can find Inside Arbitrage on insidearbitrage.com. We also acquired a Substack called the Special Situations Report. And so we published the Special Situations Report podcast. It's a mouthful. You can also find me on X at Asif Suria, and you can find me on LinkedIn at Asif Suria as well.
Very good. Well, Asif, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I look forward to our next update.
Had a wonderful time today, Bobby. Thank you so much for having me.